Okay, let's just dive right into this. Picture this. It's December 2025, and while most of the world is getting ready for the holidays, a seismic shock just ripped through the global silver market. What we're going to break down today is an event that isn't just about a price spike. It's a signal of a potential fundamental break in the entire global system for pricing one of the planet's most critical metals.
In this quote, man, it really gets right to the heart of the matter. This isn't just another headline about a hot commodity. The argument here is that this is the moment the physical reality of silver finally wrestles control away from the paper markets that have dictated its price for decades. We're essentially investigating a deep market crisis right as it's all unfolding.
So, to kick off our investigation, let's look at the price action that grabbed everyone's attention. Because, while the numbers themselves are pretty staggering, they're really just a symptom of a much, much deeper problem.
The sheer scale of this move is, well, it's something else. We're talking about a gain of over 115% in just 1 year. You see a move like that in any market, and it's historic. But for a major, global commodity like silver, it's a massive blinking red light that something profound has fundamentally changed.
And we're not just talking about a new high here. As you can see, we are witnessing the complete shattering of a record that stood for over 40 years. The market has blasted into this powerful new trading range, somewhere between $61 and $64 an ounce. This isn't a fluke, it's a paradigm shift.
But here's the real twist, and it's where our story pivots. As mind-blowing as these prices are, they are not the real story. Nope. The real story is the desperate, almost frantic official action happening behind the scenes, a full-blown panic move by market authorities as they try to get a grip on a mechanism that is fundamentally breaking apart.
So let's get to the epicenter of this earthquake. And it's not where you'd think. It isn't New York, it isn't London, it's Shanghai. What's being called the Shanghai Signal is being presented as one of the clearest signs of global panic we have ever seen, and it's coming straight from the heart of the world's physical metals trade.
Okay, so before we get into what Shanghai actually did, we have to be crystal clear on this key term, margin requirement. It's essential. A margin is not a down payment. Think of it more like a security deposit on an apartment. It's the cash you have to put up front to prove you can cover your losses if your bet goes wrong. So when an exchange jacks up margins, it's making it way, way more expensive to play the game.
Now look at this. Just look at this comparison. A typical, run-of-the-mill margin for a commodity contract is in that 5 to 10% range. That's just business as usual. The Shanghai Futures Exchange, the SHFE, just cranked their margin on silver all the way up to a staggering 17%. In the world of futures, this isn't just tapping the brakes, this is slamming on the emergency brake with everything you've got.
And the way they announced it tells you everything you need to know about their state of mind. They dropped this bombshell after the markets closed and made it effective immediately. The source material is very clear on this. Exchanges only, and I mean only, move this fast and this aggressively when they are genuinely terrified that the market is about to spiral completely out of their control. This was a panic move.
So the crucial question then is, why Shanghai? Right? Why does a move there matter so much more than one on the COMEX in New York? Well, understanding the fundamental difference between these two exchanges is the absolute key to grasping the global significance of this whole thing.
And this slide just lays it out perfectly. Think of it this way, the COMEX in New York is the paper market. It's described here as the casino. It's dominated by speculation, by financial leverage. On the other hand, the SHFE in Shanghai is the polar opposite. It's the physical market, the factory floor, where real industrial companies go to get their hands on real metal to build real things.
And that factory floor is absolutely massive. China is the undisputed heavyweight champion of industrial silver consumption. They're number one for solar panels, for electric vehicles, for countless electronics. Their demand is just relentless, and for a lot of these critical technologies, there are no good substitutes. So when the main exchange for the world's biggest physical buyer panics, you better believe it's a global red alert.
So this brings us right to the core of the argument. This panic move by Shanghai isn't happening in a vacuum. It's a symptom of a much deeper and maybe even unsolvable problem in the actual physical silver market.
So what's the underlying problem driving all this panic? Well, it starts with this number right here, 5. For 5 straight years, the world has been in a major structural supply deficit. What that means is, every single year, global industry is using up way more silver than all the mines on Earth can produce.
Just think about that. For half a decade, we haven't been living off our annual income. We've been draining the world's savings account of physical silver.
Now, you might be thinking, well, why don't they just mine more? It's a fair question, and this chart here explains the big problem: supply inflexibility. You see, over 70% of all the silver that's mined is just a byproduct of digging up other metals like copper, lead, and zinc. Mining companies can't just flip a switch and get more silver. They have to mine more of everything else, which makes the whole supply chain incredibly rigid.
And if you needed any more confirmation of the severe physical shortage, here are 2 more data points. First, the registered inventories at the COMEX, that's the silver that's actually available for delivery, are down a whopping 70% since 2020. And second, China just announced it's going to slap export restrictions on silver starting in 2026, essentially locking down its own domestic supply. The vaults are being drained, and the biggest consumer is hoarding. That's a powerful combination.
So the Shanghai Signal is the trigger. It's the proof of the panic. But where does this all lead? Well, according to this analysis, the unavoidable outcome is a complete and fundamental repricing of silver itself. Here's how that process is expected to play out.
The analysis projects this will unfold in 3 distinct and pretty dramatic phases. First, that inventory drain we've been watching is going to accelerate like crazy. The global buffer of physical silver is, for all intents and purposes, gone. Second, we're going to see a major split between the paper price you see on a screen and the actual price for a physical ounce of silver in your hand. The physical market will start calling the shots. And third, after all that dust settles, a new, much higher price floor will be established.
And what is that new price floor? The projections show it forming around $70 an ounce. Now let's be absolutely crystal clear on this point. The source material stresses that $70 is not the destination. It is the new foundation. It's the bare minimum price required to even begin to stabilize this massive physical deficit.
And from that new $70 foundation, as the rest of the world slowly wakes up to this new reality, the momentum is projected to carry the price significantly higher. The next logical price targets for 2026 start to come into focus: $85, and then the big one, the key psychological and industrial target of $100 an ounce. The argument is that this is the kind of price needed to ration an essential metal that has unstoppable demand.
So, we'll leave you with the final and pretty provocative question posed by the source material. The Shanghai Signal is far more than just a market event. It's a massive warning shot across the bow, and it forces all of us to confront a really fundamental question about our modern tech-driven world. What happens when an absolutely essential industrial metal simply becomes unobtainable at any price the system can handle?